This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, as always, and today we are pleased to welcome on Patrick Grimes, CEO and founder of Passive Investing Mastery. And we're going to be talking about some stuff that is, dear to my professional heart today, with alternative assets and some highlighting of retirement plan aspects as well. So again, we're very pleased to have you on, Patrick. If you wouldn't mind, give us a little bit of background about yourself and kind of how you came to be in the current position you are with Passive Investing Mastery.
Hey, Alex, glad to be here. And yeah, we'll both be singing the same tune today. Investing in alt assets and carving out part of your retirement account for that is key to our growth. And about a third of our investors do that. My name is Patrick Grimes. I started as a hardworking professional, like probably many of your listeners. I was a machine design, automation, and robotics engineer. I did great work with companies like Google and Lockheed and Raytheon and J&J and Abbott, but I was working extremely hard and I knew that there was more to it. So I decided to start investing outside of the stock market and outside of these company startups. Learned about real estate, got into a development project, which tanked in 2009 and 10, along with everything else in real estate. But I was very eager, young, wanting to make it happen quick. So I was way over my skis on fully recourse loans and way too much too much debt. So it took me down pretty hard. I was still a successful engineer, so I came crawling out of that. And I got an MBA, a master's in engineering, and looking for where to invest again. And the breadcrumbs of the wealth led me right back to real estate and alternatives, but in a more safer way by investing into cash flow income producing existing assets that are in recession resilient markets. And so that led me back into single family, then larger apartments, partner in about 5,000 apartment units right now. But then the allocation kind of capped out in real estate. Then you got to look elsewhere, right? 25% is highly recommended by a lot of, but not 100%, not 75%, or not 50%. So where do you go from there? So we did some oil and gas. I got Invest on Main Street was the company I built in real estate. Now we have Passive Investing Mastery. We also have litigation funding, and we have private credit, private debt, all geared around building out a more balanced allocation strategy, which is me essentially building out my strategy and allowing investors to come along with us.
Great. Awesome. And just taking a few notes on a few things that we like to kind of dive down. So when it comes to, talking about broader scope of alternatives, it's, real estate is where most people kind of get bit by that bug, right? Some people kind of come to it from the high tech area of saying, oh, well, I've invested in, private stocks. So I kind of get that, the impetus to kind of start going from that direction. But again, the broader scope of what most people are listening to us are going to identify with is, getting into real estate. Now, I've said this a lot, and I think the adage holds true is that the real estate is something I definitely disagree with being called an alternative asset. The Romans were conquering and developing real estate well before Google was ever even, a thought in anyone's mind. So, while we're talking about alternatives, again, I always like to make sure, especially if you're new, we're not talking about something that is going to be inherently extremely exotic. Real estate, falls into that category of alternatives. And some of the other stuff certainly is a little bit more, exotic to the, personal thought process of most investors, while still being based in some very solid numbers and some very solid industries that can really produce very good returns that, again, aren't going to necessarily be directly correlated to the broader securities market. And the importance of that kind of lying in when recessions come, when things start to take a turn, the broader securities market, even if you're not in an area that is directly affected, and take, for example, what happened in 2006, 7, and 8, it was the U.S. real estate markets were taking a huge hit, and financial markets. But you saw things like, let's say, you worked for Raytheon, Raytheon's stock went way down during that time, simply for the fact that it was on a traded securities market. They weren't necessarily a real estate company. They make they make defense contracting, they make, guidance missiles, and aren't single family real estate developers. So, the correlation in some of those markets can definitely help to drag down portfolio. And that's what I really like to highlight here, is how some of these things can work and how to develop a portfolio around it. So let's start with your experience in real estate. You said you got into, commercial multifamily. There were some issues you had with, being exposed to recourse debt, which can really kind of wipe you out personally if the lender can kind of come back and claw things that aren't just related to the property. But what are some kind of things that you learned that kind of help develop your current investment ethos with regard to real estate specifically?
I think those are all great points. And I don't know if I've ever said that real estate isn't an alternative. I think most people start out their 401k and they max it out. Maybe they end up with a surplus, right? And what are they going to do? They talk to their custodian. That's maybe the only resource they have. And they say, open up an IRA. And then they open up an IRA, and then they maybe max that out, maybe end up a surplus. It's that first step outside, I think, outside of the stock market. And if they get a financial planner, I think that's where things go south, because then they think, oh, they can diversify into real estate with a REIT. And I've written whole articles in Forbes about how REITs are the worst. They don't provide for any of the benefits, tangible assets, depreciable tax advantages, anti-cyclic nature to other investments. But then, so I do think potentially the next step, people maybe go buy their own rental. But then they did what I did, and that's like stress themselves out. Work hard at their day job, produce an income, and then work hard at night trying to do single family. I would probably say it is an old asset because it's an alternative to, what you have to kind of venture out on your own to learn about it. Our company really focuses on this aspect of correlation in your investment portfolio and trying to have various investments not all rise and fall at the same time. And most investors come to us more indexed in public equities, the stock market. Sometimes they'll come and say, oh, I'm in stock market, and I've graduated from there to real estate, and I've gone from do-it-myselfer to syndications, and maybe they're over-indexed in their allocation in public equities and real estate. And then we'll then say, okay, let's talk about some of the less common alternatives. So there's the common alternatives, which is real estate, gold, right? Oil and gas, and then what are the less common alternatives? And that's really where you see the hedge funds, the larger private equity firms that have access to these less common things. They know about them. That's really where you see a lot of them participating. Oil and gas is a really great alternative, especially for high income earners, and we've done quite a bit there. But you have to stomach the risk. It's a commodity and it's volatile. Gold is where a lot of people are putting a lot of their cash or cash equivalent allocations, which is 4 or 5% of some people's portfolio. What's interesting about that is gold is a safe haven. It's counter-cyclic to the stock market. It's also counter-cyclic to the US dollar. So it is a way to hedge against your savings account. If the US dollar is index is low, gold's high. If the stock market's low, gold's high. But if you're in gold in the stock market and then you're in oil and gas, it turns out that gold is correlated to oil and gas. 80% of the time, gold and oil and gas and the BRICS nations that drive a lot of the market fundamentals tend to rise and fall at the same time. So you want to look at real estate. Real estate is something that is low correlation to oil and gas, low correlation to gold, low correlation to the stock market. So it does give you, that's why we consider it a way to not have all of your portfolio down at one time. Some of the more exotic, where you kind of graduate, well, you know what, the ultra wealthy, they have about 25% in real estate, right? Then they have 25% in private equity and the other in bonds, cash equivalents, commodities. We can carve some of that out into gold and maybe a little oil and gas. But where's that other 25% going? There's other alt assets. And in order to make sure that you're investing in a way that diversifies your portfolio, true diversification means market resilience, means you have to find another asset that doesn't rise and fall with your broader portfolio. And that's, I think, where we strive as an organization, because we help investors find those and give access to those.
Yeah. So I think it's easy for people to kind of hear that and say, yes, that definitely makes sense. But let's just kind of start, and I have a few notes down here. But when it comes to at least oil and gas, it's easy to say, yes, okay, let's invest in that. But again, to kind of to your point, where you might talk to a financial advisor and they say, oh, well, you say, well, I got this extra money in my 401k, or I've left jobs, I've my 401k rolled to an IRA. I'd like to invest in some real estate. And they go, oh, well, BlackRock's got some offerings. There's a few REITs here, plug into it. Well, again, that's kind of missing the mark with, what we try to promote here on this podcast, and generally what we do professionally as alternative asset custodians. When it comes to someone saying, okay, well, oil and gas, well, I think it's a little bit harder of a correlation for people to say, okay, with the real estate, okay, yeah, there's a REIT, but I live next door to a piece of real estate. I can go buy that. You're not going down and just going to the, port of Tampa where I live and saying, I'd like to buy 3 barrels of crude oil, please. And then wheeling it to your garage and trying to go down to the local gas station and sell it. So what are some of the kind of the investment structures, at least that you kind of are passionate about, or at least available to people to invest in oil and gas? There's a bunch, that I have experience with, but I'd like to kind of hear it from you on what you're looking at in that particular market for the investment structures.
Well, so I 100%, resonate with you on the REIT first. If you look at the correlation of REITs, it correlates with the S&P 500. So there's no attribute to real estate there. Real estate ownership is a completely different cycle. Oil and gas is there's a broad spectrum, like in many things. There's a lot of ways you can invest, and some are more risky and some are less risky. My dad's dad had his great grandfather has an oil trust where there's mineral rights, and over generations, and it's shrinked over time, obviously, but over generations, our family has collected long-term, low-risk passive income, and that has risen and fallen with the price of oil. But that cycle has not gone along with the stock market or real estate over time. So that has been a long-term, secure, low risk. So there are ways in oil and gas in which you can participate in essentially just buying cash flow. And we're working on a project right now, and where you can do that. You can just essentially buy royalties. You can buy cash flow, and you can forever cash flow. It depletes over time. Typically, you earn your money full investment back. Those returns are sometimes anywhere from like the 8 to 13% usually royalties per year. And you can usually get your capital back in that, 5 to 7 years over those, just, that ongoing cash flow. And then those things will cash flow for generations after that. It will deplete down. And oftentimes if you're buying royalties, sometimes they'll drill more on those, and then maybe the cash flow will go up. So there's very low risk ways, and those are very conducive to retirement account allocations. Now, a lot of the people, when they think oil and gas, they think drilling. That's when you can get yourself into trouble if you're not very careful. Just like any investment, you can get into a great deal with a bad sponsor, and they can make a great deal into a bad deal. You can get into a great deal with a good sponsor, and then just get unlucky. Because when you're trying to get into an early stage exploratory type, call it wildcatting investment in oil and gas, it's kind of like angel investing, where you're in a startup where you're not really sure. A lot of people will spread a lot of money across a lot of startup companies to try and angel invest, to try and make it big. Well, that's a little bit like wildcatting, right? You're kind of just going out into a field and you're doing the best you think you can and just trying to find oil where it hasn't been found yet. Sort of in another step forward, instead of trying to go for 100x returns in the wildcatting, some people will go for drilling next to or analogous or adjacent to other wells. And of course, it's more expensive, right? Because less risk is taken out, so it's a little less returning. But when you are doing those specific drilling projects, you have to find, of course, the right operator. You have to do the right geologist. There's all these things to it. But then you can drill. And when you're paying money to drill, that's called working interest, not royalties, that the government incentivizes, like real estate. The government needs us to produce energy. They need us to produce housing. They also need us to produce food. All of these things come with huge tax incentives to help offset the risk and to incentivize us business people to go do it and provide that service. So ordinary income write-offs, if you've earned $100,000 in ordinary income and you put it into an oil and gas deal, that's doing a drilling project. It's not uncommon. You get 100% or 90% active income write-off, and all of that income you don't pay taxes on. It's not uncommon. But it comes with a risk because you're trying to create something and you may or may not find that oil or find it within budget. And so a lot of people just don't have the stomach for it. That is a tougher nut to crack. And I think that on those drilling projects, while they provide really great tax advantages, there's a reason why it's a higher risk. There's potentially, you don't want to let the tax tail wag the dog, and you don't want to over allocate yourself into those projects because of the risk profile. And there's potentially other investments that I often recommend people get into depending upon their risk profile.
Yeah, that's really interesting. And, it's as far as kind of like the general stack of oil and gas, the primary areas that I've seen have been more to the, the acquisition of royalties. I've also seen oil and gas company bond issuance, purchases through retirement plans. But the aspect of wildcatting was also kind of interesting in the analogy that you drew to it being more akin to angel investing, which is a good thing that I like to make sure we can, always draw good analogies and parallels for our audience, because it's great to learn the information, but when you can relate it back to something that might be a little bit more, something that you more well understand, I think that's very important. Now, throughout these three different basic ones, the oil and gas investing and oil and gas royalty investing, drill exploration as adjacent to already proven claims, and then basically the kind of the rolling of the dice and the wildcatting. Are there different reasons why someone from a tax perspective would want one? I mean, I think you mentioned that the latter of the two offer very good, like, ordinary income write-offs. Is there a loss from the royalty aspect side? Do some of those kind of play better to different investors, not just from a risk profile, but from a taxation profile?
Yeah, so much less dramatically so. There's depletion allowances in the royalty side. And just to be clear, though, that the allocation of the tax advantages are not so helpful when inside a retirement account, for all these purposes. So you would that may be the one allocation I would say. Sometimes people choose not to use their retirement account, just to be clear. But yeah, so the more risky it is, the more advantageous you're going to get. The royalties do not have the ordinary income, optionality to it. The tax advantages actually go pretty deep too, just like real estate, and oil and gas, and also small business investments like angel investing. They offer 1031 exchanges. They offer a variance of the 1031 exchange, which allow you to actually take those investments and roll them forward without paying taxes. So all of them have similar risk profiles. The government incentivizes them in a similar way to allow you to continue. And then so once you invest in those kinds of asset classes, start angel investing in businesses, qualified small business stocks, right? And real estate and oil, they want you to keep your money there. They want you to keep rolling it forward. They don't want you to, I got a big win, I'll go buy a Ferrari, because that doesn't help that engine house and energize America. And similar with, ag. So what I do say, though, is those are kind of like the known investments. Like, people know about those along with gold, right? But there's others. There's others out there that we actually think are better. In fact, if you look at what are more stable investments, which show non-correlation, which means their fundamentals behind those businesses don't rise and fall. They're not dependent upon the same market fundamentals of the stock market, interest rates, not dependent on the same market fundamentals of oil and gas, commodities, real estate, all those. There's options in healthcare. In recessions, people still need to get healthy. There's options in education. People actually tend to go get educated more in downturns. And there's options in litigation funding or legal services. Now, all of these things are needed in good times and bad times. In legal services, it actually oftentimes is a little countercyclical, and people get more litigious in downturns. But if you look at the correlations, and we provide these graphs of different asset classes where the more popular ones are actually the most volatile: real estate, stock market, oil and gas, gold. But the less popular ones are just steady, tried and true growth, like education, healthcare, and legal services. And so by investing in some of these less popular and finding avenues in which, like we do with our legal services or litigation funding, you can get into investments. Now, similar to oil and gas or real estate, you can get into development, which is more risky, or wildcatting or drilling, which is more risky, or late stage stuff, which is less risky. You can get 100x returns on some high gambles, or you can get 20, 30x returns on very much lower risk, all while in a very stable market and investments that won't rise and fall with the rest of your portfolio. That's where I think people should focus, right? Not on kind of the chasing the tax advantaged investments all the time for all of their portfolio, but focusing on balanced allocations for recession resilience is really what allows you to make your money and keep it.
Yeah, absolutely. And I think to the point of that, hedging in resilience to these downturns that will happen. It is not a matter of if, it's when, and it's not a matter of, and it's a matter of how bad. The looking at it over a broad enough amortization, like you looked at any industry, any empire, you will see economies rise and fall. Hopefully they don't go away, but you can track these things. I mean, even going back to tulips in the Netherlands, you can see how these things work. And to shield yourself with assets that don't have that rise and fall, you might give up the ability to make a 30-40x return. But if you make a 30-40x return in a securities market and then you have a 25% retraction, well, that's pretty easy math to say, how much did you actually make? Well, maybe it was closer to 10, probably is going to be closer to the single digits, I'd imagine, if you're in, again, staking your claim to something so specific as that. But to the point that you're making of these other kind of more niche alternatives, I find fascinating. I had one gentleman on, probably it might have been even last year, but we talked about litigation finance, and that's something that I found absolutely fascinating. And I'd really like to kind of get into that of, maybe giving a little bit more example of, what the returns look like, how these investments actually structure. Because most people, and myself included beforehand, thought that, hey, you see a big class action lawsuit. It's like, did you have mesothelioma? Did you do X, Y, or Z? Or even, larger, smaller tort cases. Attorneys have to put up money for this kind of stuff. These are mainly things that are done on contingency. So they have to find a way to fund the experts, the interviews, and all the stuff that goes into it. So let's talk a little bit about that. Because I think it's a very underserved aspect of finance in general that, from my, again, very limited understanding, can offer some very good non-correlated returns to broader stock markets and just good returns in general.
Yeah, well, so anytime you find the right industry that has that stability, that long-term non-correlation to your other portfolio, you got to figure out how to access it. And when you figure out how to access that from an investor, you want to think of what need you're going to fill. And the legal services industry is very simple. It's hourly rates. Mm-hmm. They don't have a really complex supply chain with cost of goods sold, and they're not drilling anywhere. They don't have it's just hours, right? It's the amount of hours and the price per hours, and it's how much they collect of their billed hours. And if you look at charts over time, it's steady throughout all the volatility. The amount that they charge, the percent collected, is just steady growth, right? And the increase in the hourly rate is just steady growth. And so, trying to invest inside of that, to your point, you have to find out when does it break down for attorneys? When does that break down? When do they need help funding their hourly rate? Well, it often comes when they're trying to give access to justice to somebody who otherwise wouldn't be able to afford it. And that is in a lot of these cases where an attorney will run a contingency fee. It's not pro bono, meaning they're doing it for free. It means they're going to defer their payment and they're making it dependent upon the success, and they're going to take a percent of the success, the settlement, the award, the judgment. And then you kind of get into the same kind of situation. You're going to partner with an attorney. You're going to fund an attorney. You got to make sure that they're kind of borrowing from you in that case. So just like our private credit, private debt fund, we want to make sure that the borrower is a very strong borrower. Well capitalized. They've got skin in the game. They're putting up capital too. They believe in this. They've got a track record of executing, just like a real estate investor, a developer on these, and they have past awards and settlements that they've been able to do. And then we take a look at the stage in which we want to invest. We don't want to be the wildcatter or the angel investor getting in early, taking a high risk and getting 100x return. We want it to be a very late stage where the attorney has taken this almost to the end and they're looking at needing more help to pay their court fees, to pay their hourly rates, to get these late stage cases over the finish line. And that allows us to return 20, 30 plus returns instead of 100x returns. But the types of cases that we can get involved in, we don't really do class action. Class action is everybody joining one lawsuit. We tend to work on individual claims where lots of lawsuits, lots of independent lawsuits are rolled up into one, which is called a tort. A tort means tortum. Tortum in Latin means wrong. So a tort just means a wrong. And a mass tort means a mass wrong by a really strong defendant. We look for very strong corporates, which basically corporations have that misconduct. And some of the examples are just frightening. Like one of the ones that we have 1,200 cases in our current litigation fund for just the Camp Lejeune. Camp Lejeune is a military base that trains our military personnel. It's a Marine base, but lots of military personnel from various types of the military there training before they go to war. The military personnel as well as the civilians that lived on that base drank contaminated water. The Department of Justice knew about it. They failed to take action. And now there are the heroes of our life suffering with cancer, dying horrific deaths because of this. And there was a bipartisan piece of legislation passed. Talk about late stage, bipartisan admitting causality and admitting liability. And then they published a grid saying, if you're in Camp Lejeune and you have these symptoms for these amount of years, here's your award. How late stage is that, right? I mean, and how solvent is that defendant, right? That company to pay. So it's just a matter now of doing two things: helping the attorneys with funds to market, to find more claimants that have been harmed, and helping the attorneys fund their operations to take those claims through. Similarly with Roundup, Monsanto, company knew that Roundup was causing cancer. And these farmers are bathing in it essentially. And these tractors, mass sprayers, right? And they hid and falsified documents. They put pressure on regulators. The regulators have since even retracted some of those documents that they lobbied to falsely get produced. They're losing claims right now, punitive damage claims, and it's a mass tort. Now it's being rolled up. We can help find more people that have been harmed and help fund the attorneys to then get settlements. This is very, very late staged. Firefighter foam. We're talking like the military and our firefighters, the heroes of our world, were given firefighter foam by 3M. It's a product AFFF made by PFAS, made by DuPont. And they use this for decades. And now they're dying of horrific cancers. And they knew back in 1985 that it caused problems. They never changed the product. And now there's, again, a legislation out there. And we don't need the legislation to pass because we can if the legislation passes, that means the government's also going to fund a relief. But we can still continue. They've lost billions of dollars in settlements now. And so it's just a matter of finding more firefighters and military personnel exposed. And then we're partnering with these same litigators who have gotten multiple settlements to then take them to fruition. So you can participate in diversification off, a dozen different types of cases. You can thousands of claimants. Those are individual cases across thousands of claimants. And you can participate in returns derived from those awards. Those awards are not affected by the rise and fall of anything else, right? And as long as you get in late stage and you go with a strong borrower, and the returns are highly coveted by hedge funds, sovereign funds, private equity firms for the lower risk, non-correlated nature. And that's an example. And you're also doing good, like impact investing and ESG praise these specific niche of litigation funding for the good impact that they have on society. And so it actually is giving access to justice for those that otherwise wouldn't.
Yeah, absolutely. Ironically enough, two of the things that you mentioned in there are both from the same company. So maybe look out at if you're holding any DuPont or Dow Chemical stock. They have a lot of them out there. They also have the earplug thing. They also were involved in the Teflon issue. Yeah.
So Teflon is the same as the PFAS and AFFF.
Yeah.
And
Yeah.
they did lose an earplug, and they paid out. But you also have to look at that they have not changed these products. They have not changed these products. Why? Because the settlements have not exceeded the yearly profits of these products. Same thing with talcum powder. J&J's lost 2 different mass tort settlements for talcum powder. They never changed the product. Cervical cancer. They're creating cervical cancer in women. And they've lost 2, but they still have not changed it. Now they're going for a third round. Why? It's because it's so profitable. It's more profitable than the settlements.
That's absolutely mind-boggling to me. And we could sit here and bash, the greedy corporate culture of the United States, which I'd be happy to do. But it's mind-boggling. But it does create. And again, it's an unfortunate use case, but also, at the end of the day, this financing, this type of investment structure is going to directly help those that are hurt, that are affected by this tort claim, to try to make them whole. It's not going to replace the, father they lost or the sister that got cervical cancer from talcum powder, but it does hold those responsible to a measurable degree. And I think, again, that's something that you can invest with dollars and cents, but if you can also invest along things that align with your core beliefs and values, it's a nice benefit as well.
It is a nice benefit as well. And what's interesting is litigation funding, as it's been growing, it has changed the calculus for some of these larger corporations to begin to shift their risk management, which is essentially all it is for them, risk management, to lean more towards adapting their products more quickly if they see issues than just having these legacy products still run on the market. But one other thing you mentioned, which was very interesting about litigation funding, is so the ability for it to write in a retirement account and the ability for it to provide for allocations. I just wanted to mention that because I know that you wanted me to circle back to that. Litigation funding fits perfectly in that space because as you invest, as we structure these deals, equity-like, they're basically equity loans with equity-like returns into law firms. Those go in as what's called a prepaid forward. Well, what that means is it's an asset on the books, and it comes out as the returns come out as capital gains. So it allows you to defer those returns in a retirement account. And outside of a retirement account, it allows you to use other passive losses or other capital losses that you may have had to offset those gains. It's also in a very tax advantage structure that facilitates, without any issues like UBIT or UDFI that you have in real estate, it's shielded from all of that. It just provides for a very simple structure for allocations from a retirement account.
Now, that's important to understand because typically when you look at things, I'd imagine that most of the time when you talk litigation finance, it is going to be something where you are, you're not just, the end use investor is not writing a check to a law firm. It's going to be structured into some type of like special purpose entity or limited partnership where it's going to be managed and then invested downstream, and then the returns pay back on K1 to some extent, right? Is that the general high level of how that kind of stuff normally works?
Yeah, but the way that it's structured from a tax perspective is exactly that. We're investing through contracts that give us preferred positions. So we get the first dollar in our in our current one of our current contracts. We get the first dollar until we reach 1.3 equity multiple or a 26% IRR from the attorney. So you get a very downside protected return, especially when you're diversified across numerous attorneys, numerous cases, and thousands of claimants. And then when those come back, you get that preferred position. When those come back, they come back on your K1 as a capital gain.
Nice. And so just so I understand this and our listeners can as well, when you lend to an attorney, again, we're using the word lend because it is a note, but it has other things that are based into it. It's not just a stated, fee simple note, right? It's not just 8% interest over 10 years until repaid, right? So what is the additional kind of kickers that are written into this? Are you clawing a portion of the awarded settlement? What kind of drives those higher return numbers that you see in this?
So it's analogous to a loan, but we don't like to use the word loan because it implies that it's secured by a piece of, with our real estate investors, it implies that it's secured by a piece of real property, right? Because we also have a private credit fund where we are at a 58% loan to value, first position, on a spread of 89 loans. And so we tend to say that it's more investment than loan, because what the security is a position on the outcome of these settlements. And the waterfalls that we have for return structures, like we said, we have a preferred position on the first dollars, and then we reduce our position as the fund, as the settlement is higher, the fund participates in less and less. And that allows us to get to our target, 2.5x multiple very quickly, and to our 20 to 30% internal return very quickly. And then it allows us to see some of the upside, but again, we're about downside risk. That waterfall structure is on a deal by deal basis, and it has other things in there, like are we taking a claim to investing in their existing collateral, like we're investing into existing Camp Lejeune claims because they need money to then continue to go after those claims and take them to fruition, or are we investing into marketing to help them find new claimants, find new individuals that were harmed in this similar tort? And that's a process of investing for marketing and onboarding and getting a legal representation. Both of those have a little bit different collateral structures. A collateral structure being maybe we'll have a position on the new claimants coming in, and maybe because we're originating those claimants, we're going to have a higher position on those. And then when we're buying an existing docket, it's very low risk, right? Because they're already there. And especially like in Camp Lejeune, it's just a matter right now, the government's already said, this is what you get. That's like the worst case scenario. And it's just a matter of running through. So there may be a little bit lower, but that gives us a lot of downside protection, right, in the fund by investing in those existing. So those structures have been around for a long time. I think 1905 was the first funding in America, and it was against American tobacco. It was going against these companies that, hey, you know what, these cigarettes you've been giving us, I think it's giving everybody cancer. Let's all band together, right? And all these people dying of cancer don't have the funds to do it, but let's help them by helping to fund the attorney going up against American tobacco. That's how this in America started. But it's actually been going around for a lot longer. It's been going, litigation funding or the assistance to attorneys to allow them to work on contingency fees because the person they're defending can't afford it. That's been going, I think, I can't remember what it was, something like in Greece or something, like thousands of years. And, it was the very first take on this idea of litigation funding.
Yeah, and I think, again, that's one of the things where, I've learned a lot on this podcast and professionally, but that was one of the cooler avenues of investment that I never would have ever really thought about. And, I've seen people make money in all sorts of interesting ways. It's about as PC as I can say, but it just it always amazes me when I learn something new, especially to this extent, because what I like about it is that one, it's not it's not complicated to understand. You're not trying to understand crazy put call options and things on the stock market. It's people have a need for money. These people are trying to help people through the legal system, and there is opportunity for, again, people to get compensation or as made whole as they can if they were injured or some otherwise affected, and for people to make money, and also again, to be doing something good with your money because people are definitely directly benefiting from it. So
And
very
ethically, right?
yeah, ethically, yeah.
Ethically, but it's also important to know that we don't take any deal where the claimant's getting less than half, right? It's expensive to go through litigation. To solve problems through the court system is very expensive. So we have to have the right case profile, defendant profile, so that we know that they can pay, we know the settlements are there, and then we can pay for everything and still give them over half or over of the settlement value, and help and otherwise give them that they wouldn't otherwise have. So it's all there. It all wraps together. That's why it's one of my favorites.
Yeah, no, it's something that I certainly, and I'm glad we were talking about it because I'm doing some repositioning of my personal portfolios, and certainly something I'd like to, look farther into, especially with what I think is coming in the next 18 months or so. I think there's going to be some interesting shifts. Everyone's like, well, how bad is it going to be? It's like, no one knows. And if they tell you they do, they also don't know.
Well, those who don't know, and those who think they know, don't know, they don't know. But my general sense is that I'm an engineer, I'm an analyst, right? And so I think in probabilistic nature, it's just my nature. And if you look at any of our decks right now, it basically says, when's the time to prepare for a downturn? It's always, right? Because you don't know. But if there's any time to jumpstart you into planning for market volatility, it's today. It's not often that real estate and the stock market are down at the same time. Okay, it was the case in 2009 and 10, but right now the real estate and both residential and commercial are down nationally. Commercial more so than 2009 and 10. But what are equities going to do? What's the economy going to do? 11 out of the last 14 Fed rate hikes ended in a recession. 11 of the last 14 rate hikes. I mean, in our decks we show these numbers and the actual dates, the beginning of the rate hike and end of the rate hike. Probabilistically, are we headed to a crash? Very, very probable. Will it happen? I don't know. Frankly, I don't care because I'm going to prepare for it. So I can not be in a situation where I was when I was in 2009 and 10, way over indexed into one asset class, way in that asset class in a way risky position where I lost everything. I'm going to be allocated into various alts, non-correlated to each other, so that I can sleep at night and I know that what I've worked so hard to earn, I can keep.
Yeah, because it's not what you earn, it's what you keep. The old adage holds true. And to kind of round this off, private credit and what you were talking about, I think that's another one that people should definitely be more exposed to, at least educationally. The fact that it's not just your American Express card in your wallet, or your Chase card or whatever you have. There's opportunities for investment in privatized credit. So maybe let's kind of explore that as the kind of end cap of what we've been talking about today for the alts section.
Well, it is also a really great product for retirement accounts because it doesn't, it's so low risk that it doesn't offer tax advantages. So if you look at the allocation of the wealthy, they have 6-7% in fixed income, right? And 5-6-7% in real estate, depending upon what you're looking at. This kind of fits both of those, right? Where you can do, just like when the lending crashed after the subprime mortgage collapse, private credit exploded after that. We're seeing the same kind of situation now, where we had a record high bubble of short-term bridge loans in commercial real estate. That's the 2 to 5 year loans. Not the long 50, 20, 30, 40 year HUD loans and Fannie Freddie loans. We had a 2-year bubble, artificially inflated real estate prices, a lot of short-term bridge debt right before COVID, right? And then all of a sudden that's coming due. But what happened since then, when this clock's been ticking in those short-term bridge loans, which is hard, that's hard money loans, but in the commercial space, they call it bridge loans, right? What happens in between what happened? interest rates skyrocketed. Costs of operations went up, payroll, materials inflated. Then delinquency skyrocketed because people stopped paying rent. Then there was an eviction backlog, which shrunk everybody's operational budget. So you're seeing right now $1.5 trillion in commercial real estate debt coming due in the next couple of years. 64 billion is some of the numbers that you're seeing in how much of the distressed properties there are because of environmental factors, not even because of the debt, at a time when they have to refinance. But what happens? How are they going to service these loans? The lenders were diversifying into bonds. Well, as interest rates went up, their old bonds at the lower interest rates now devalued. They have to sell off to get liquidity at a loss. Meanwhile, all these regional banks, these real estate deals they lent on, which were supposed to be the cornerstone of their risk profile, are now not worth as much as they were before. The owners are defaulting because of all these environmental issues that they had through COVID, in addition to the interest rates. And so they're in a liquidity crunch. So private credit is the ability for us not to act like banks, but to act like private lenders, to fill this void. When you want to access something, you got to find a need, just like we do in litigation funding. And right now, what used to be 6, 7, 8% loans on performing properties, not distressed assets, we're like performing properties, right? We're now lending 11, 12, 13, 15, 16%. And instead of doing 70% loan to value, we're at a 58% across the spread, loan to value. And not this isn't a residential, this is a small balance commercial. Residential lends 100% loan to value because they do after repaired value or after completed value. So the value's not even there they're lending on, right? We're in current value, loan to current value, 58% current value, right? And that means when you've seen 10, 20, 30% fluctuations nationally in commercial real estate, but we're sitting pretty down at 58%. And we're cash flowing right now on 90-day notes where you can invest for 90 days, or 60-day notes, or 6-month notes where you can invest for half year, or 1-year notes. We're cash flowing respectively at 7, 8.5, and 10% at a 58% loan to value, senior secured. Now it's amazing. And then our 3 years have been trending above 10%. Our 3-year lockups have been trending closer to 12.5, 13, 14%. So a way for you to get equity-like returns, but in a senior secured lower risk position through notes or positions in our loan or equity positions in our loan portfolio, private credit. And this will go on for another 3 to 5 years. Jerome Powell just got on saying that the full impact on the commercial banking system due to the collapse of commercial real estate's yet to really begin. We're seeing it play out now. We're providing a need to the industry and providing great returns to our investors. I otherwise wouldn't have a debt fund. I otherwise wouldn't. It's opportunistic. My partner, Lance, has been doing this for 15 years, and we stood this up opportunistically to provide the upside of the downturn in a form of cash flow when investors are having a hard time finding cash flow.
Yeah, it's going to be a real interesting time in commercial real estate, just with how some of the deals that I've seen be underwritten. Because one of the cool things about my job is I get to look at a ton of sets of subdocs and PPMs and prospectuses. So I get to see a lot of different stuff that people are doing, and I agree with some of it. I don't agree with chunks of it, and some of it I'm just looking at it to a perspective where I'm like, sometimes it's tough to see where this really makes sense in the next few years. But I hope I'm wrong on most of it. But again, it's interesting to see, and also from the perspective, not just withstanding the the commercial real estate space, talking about apartment complexes, other light industrial uses, things like that. But what is really going to kind of be an interesting anchor to the market, I mean, a boat anchor, more or less, and not in a good way, is what's going to become of these investors that have been primarily hedged on commercial office space. What's going to necessarily happen with that market, because it's not an asset that can be repositioned easily. Someone made a great analogy of saying, well, I was interviewing them, and it's like, well, it's great. These buildings could look nice, but the big problem is the infrastructure in the buildings. You can't take an office building and just put up walls and kitchens. They don't have the plumbing for it. They don't have the electrical for it. So you're talking about taking these assets, and if you want to try to reposition them, how much is it going to cost you to do so? And it's automatically just kind of from the rip of looking at it, might already tank the deal. So what's going to happen? It's going to be a tough one to see, but I think that's also going to have kind of an outsized effect on what's going to happen in the next 3 or 4 years, notwithstanding just what's happening with interest rates.
The effect of office is going to affect all of real estate because it's going to affect the banks, which services all of real estate. And so there is a challenge there. Offices, and there is a challenge for whole municipalities because a lot of municipalities were relying on the taxes for the commercial real estate to provide their budget as well. And the devaluations, as places like Boston are struggling right now because a large proportion of their income. Office right now is something we've excluded from our debt fund, from our recessionary income fund. It's something we've excluded from our acquisitions fund where we're buying commercial assets in cash right now. It's the best buying opportunity in my life. Prices are lower now than they were in 2009 and 10. So our recessionary acquisitions fund, we've excluded office. And the reason is because I think somebody's going to make a lot of money in office because they're going to tackle it. They're going to figure out how to reposition some of these buildings into other things. But the numbers I've seen is only 6% of office can even be converted to something else, like a multifamily apartment or an industrial building. They were built specifically for offices. And in order for those conversions to even happen, you would have to sell those office buildings at less than 20 cents on the dollar for it to make sense, which means you've already had a collapse of the debt position in those office buildings. And then you have to have the governments in the local areas come in and provide exceptions to all the codes that you have and completely restructure everything surrounding the apartment building industry to facilitate it. That hasn't happened yet. So it's going to be interesting to see. We're going to continue to ride the private credit side for non-office income producing real estate. We're going to continue to buy non-office commercial. I am very interested to see how somebody shows up and comes up with a business plan, which I've looked at a few, which is going to allow for a recovery of the office space, which it's not going to come back. Those are not going to come back.
And, as much as I don't want to see any industry, falter, fail, and flounder, especially if it's going to drag down something that I believe and invest in. But again, it's the case study, in 15 years is going to be fascinating to read, of what happened and how this problem was solved. It's going to be solved one way or another. You're not going to see a, 15-story type A office complex just languish. Something's going to happen with it. And what that is, who knows? It's tough because it's like if you can't put people in there, it's like, well, then you can't turn it into a metal foundry. But then okay, well, I've seen people talk about doing data farms and other type of non heavy industrial uses for them. But then you have infrastructure concerns and what does that look like? So it's going to be interesting. It's going to be very, very interesting to see where that happens. And several people that I've talked to kind of in your position that do private credit, that are on the private debt side of things, I haven't met a single person that's willing to touch it yet either. So
very allergic.
I have someone that I can call and be like, hey, what are your thoughts on this? Because everyone, at least that I've talked to, is staying well and far away from it.
Man, I've done my whole back in 2007 try and get head over my skis for a get rich quick move and lost everything. I'm going to stick to my tried and true, buy assets at cash flow, make my returns going in, and invest in non-correlated, stabilized industries. That's my path, and may not be the most sexy, but it's working for us.
And I think that's kind of a good way to draw this into a close is, the theory or the fundamental of investing in diverse, non-correlated assets, because if one thing starts to go down, you don't want them all to be correlated. And especially if you're investing strictly on a stock market, that becomes ever apparent. It's just because one thing is happening or something is going on in another region of the world can drive down an entire market of tradable securities. Again, looking at alternatives can certainly offer you a degree of hedge for that. You need to make sure you're doing everything with proper due diligence, proper research, understand what you're doing, but look at numbers. Talk to people like Patrick. Examine some of the stuff that we have as far as our educational materials to learn more about these, and see if it works well in your portfolio. So, with that said, Patrick, again, I really do appreciate you being on with us today. It was a great conversation. I really, really enjoyed it. If people want to learn more about what you have going on or any products or services that you might have in the market, what's the best way for them to reach you?
Well, I often offer a copy of my book. I did a chapter in a book. It's called Persistence, Pivots, and Game Changers, Turning Challenges and Opportunities. I tell my whole story, ups and downs through high tech, real estate, losing it all, coming back. Phil Collin, lead guitarist at Def Leppard, did a chapter. Some other entrepreneurs, coaches, NFL, NBA. Really fun book to participate in. If anybody wants a copy, they can go to our website, Passive Investing Mastery, passiveinvestingmastery.com. On that website, you're going to see all of our investments and the ability to schedule a call with me. I'd love to chat with you wherever you're at. It's one of the things that I love to do. Talking to investors is part of my why, investing in people's lives. If you'd like a copy of the book, passiveinvestingmastery.com/book. That's the secret link. And make sure you put the name of this podcast in there, Advanta IRA, so that we know you are. And then I sign it and we ship out a free copy. This is me just giving back. And if it inspires somebody who's out there slaving away at the 8 to 5 like I used to be without a way out, if it inspires you further on your path to alternatives and escaping the grind earlier, then it's enough. Thanks for me. And looking forward to speaking with anybody. Happy to chat. Patrick at passiveinvestingmastery.com is my email, or you can schedule a meeting right on my calendar on our website.
Fantastic. Well, thank you so much, Patrick. The most valuable asset we all have is our time, because we can't make any more of it no matter how well we invest it. So thank you so much for being with us today. Again, this has been the Alternative Investing Advantage podcast. My name is Alex Perny, and we will catch you on the next one.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.